Good afternoon, and welcome to AIABA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that has registered for today's program will receive a copy by the end of the week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Now join me in welcoming back Jonathan Smoke, Cox Automotive's Chief Economist, who focuses on economic and automotive industry trends. Jonathan, take it away.
Thank you, Rachel. We've put together a pretty broad range of content to keep everybody up to date with what's been going on in the economy and the auto market. It certainly has been a very interesting year, to say the least, and we seem to be kind of impacted by news events virtually every day. I can't make promises of just how exciting and positive the presentation would be. Economists are often called the dismal scientists for a reason, and you're going to see that front and center because the first thing I want to discuss today is the threat or the possibility of a recession occurring in the next year to 2 years. This is specifically to address that what we see going on in the overall global economy and now cascading into the U.S. is that economic growth is slowing. The U.S. economy experienced 2% growth, real growth in GDP in the second quarter of this year, and it looks like we're on pace for even slower growth in this current quarter, Q3, and projected in Q4. What's behind this is essentially a decline that's occurring in manufacturing as a result of a lot of the trade uncertainty and trade wars occurring principally between the U.S. and China, but as we'll discuss as it relates to autos, certainly have threats cascading into other regions. And perhaps most importantly, it's created a significant amount of uncertainty that's translating into businesses being more conservative, and businesses being more conservative, ordering less, being impacted by tariffs is essentially why we're already seeing manufacturing decline globally, and that includes in the U.S. in the latest data. So the key question becomes, will we have a recession as a result of this? As I'm showing in this chart, this is an index from the New York Fed, which they specifically label as a probability of recession occurring within the next 12 months. Now, I guess you can take it as a good news that the number is only 38%, and so if you're considering a probability, something less than 50% certainly sounds better than something that's more than 50%. But if you look back historically, the recession periods are labeled or marked in gray. Every time that this index actually got above 30, we basically then saw the U.S. go into recession within 12 to 24 months following. The number at 38 in August is not quite to the levels that we saw prior to the last two recessions, but it is now higher than what we saw in the 2001 session. I'm also noting in the comment up above that 74% of business economists surveyed in August expect a recession to occur by 2021. So within the 1 to 3 year horizon, the way to look at the economy in general is that we are facing higher risks of a recession. It's not a given, however, because we certainly can see moves by the Federal Reserve to loosen up monetary policy, and we're looking at a meeting tomorrow that's indeed likely to cut rates. We have the possibility of trade deals resolving a lot of the issue that's hanging over trade globally and the issues that are plaguing manufacturing. But also, it would be predicated on no more negative shocks like the shock we had from the attack in Saudi Arabia this weekend and what's been cascading through the oil market. But now that I've gotten the really negative perspective out of the way, let's talk about what has been good in the U.S. economy, and it's largely related to the consumer and related to the job market in particular. We continue, despite having now the longest expansion in history, to see a healthy number of jobs created, although the job creation is starting to slow down. It is still enough to keep unemployment at a near 50-year low, and actually we have the potential of seeing unemployment tick down a bit lower. Unemployment is strongly correlated to consumer confidence, and that's what's on the second chart here. The gray bars that are in the background are the overall consumer confidence index level coming from the Conference Board. And we officially reached a 20-year high back in October. And if you kind of drill into that section of the chart from October to where we are today in August, we've indeed been on a bit of a roller coaster ride where quite literally almost every other month has been up or down on that consumer index. And a lot of it has to do with the stock market volatility and a lot of the negative news regarding trade that in particular has gotten more volatile as this year has progressed. The blue line looks even more like a roller coaster ride, especially over the last 2 years, and that's the percentage of households within the survey that are saying they plan to purchase a vehicle in the next 6 months. Now, it's very interesting, though, that even though it's been volatile, if you smooth it out, which is what the green line does, we essentially are not really seeing consumers back down on their plans, but they seem to be impacted up and down month to month. Just a case in point, just a few months ago in May, we registered the highest percentage of households ever reported in the survey planning to purchase a vehicle in the next 6 months. Then we saw it decline, but we've actually seen improvement over the last 2 months in both July and August. So I wanted to drill down into the Consumer Confidence Index and look at the two metrics that actually come together to produce that index. It's actually two questions, one related to how consumers feel about the present, which is measured in the red line in this chart, and then one that's asking them how they feel about the future. And the most important thing to note is that we are seeing a big gap emerge. And unfortunately, that gap itself is not a good sign, as you can relate to the prior two recessions, that when there's a big gap that consumers are feeling good about their present but not feeling as good about the future, that tends to relate to a slowdown in the economy that eventually turns into a recession. So again, we're seeing a perspective that the consumer, while employed and generally feeling positive, is not feeling 100% great about the future. Now, part of that, I believe, has to do with their own economic well-being is not as strong this year, especially as they look back and see just how they were improved last year. And a lot of that has to do with tax reform. On this chart, we're looking at disposable income and spending and personal income and spending overall. Last year's growth is measured in the gray bars, and this year's growth through July is measured in the blue bars. So last year we had very positive growth in household income, which included wages but also other forms of income. And at the same time, we had a reduction in tax rates that effectively meant that almost all of the growth that we all enjoyed in income last year went immediately into our pocketbooks, or we saw even stronger growth in disposable income, which is what is left over when you take taxes out of income. And that translated into a healthy growth in spending. Basically, we received all that disposable income in our pocketbooks and we spent almost all of it. The only negative last year was a double-digit increase in interest rates. Now, flash forward to this year, we're still seeing positive income growth, but it's not quite like last year. We're now having to pay more in taxes because our rates are fixed, and so we're no longer benefiting from a rate deduction. So as a result, we're actually seeing less growth in our pocketbooks than we're seeing growth in income, so very different from last year. And as a result, we're spending less. So I think that's a good perspective on why, even though the economy is seemingly just as strong from an employment perspective, we're just not seeing consumers spend as much, and that includes on vehicles. But there's also another perspective that maybe the averages for the consumer are masking the fact that some consumers are actually facing some financial difficulty. And one very important indicator in that is with auto loan severe delinquencies. This chart is charting the total auto loan severe delinquency rate, which is someone behind on their payment by 60 days or more, and that's represented in the gray line at the bottom. And then we filter into just the subprime borrowers in the red line at the top. There is a lot of seasonality in severe delinquencies, especially in subprime relative to the market overall, and that's because consumers tend to get behind on their bills and their credit cards and their auto loans in the holiday season, and then they benefit from tax refunds helping to get them current. So we see the rates effectively reach a low within a year, roughly in the tax refund season time around March and April, and then you see their spending go up and delinquency rate deteriorate. So what's important is to compare the year-over-year numbers, and unfortunately what we've been seeing in that data since July of last year has been a delinquency rate for subprime, not for the market overall, but for subprime, that has been at a 10-year high, and that's been every single month from October until July in the Equifax data. And that comparison to 10 years ago is a really rough one because that's 2009 during the Great Recession. And so that's a very bad comparison to be making in terms of how subprime borrowers are performing. And related to that, we've been starting to see credit tightening throughout the year, which has produced an interesting change in what's happened with interest rates, because interest rates have clearly been on the move this year. When you look back at where we were at the end of last year, the expectations were that the Fed was going to increase rates potentially 2 more times in 2019. Instead, we did have an increase in December, but since then, we've had a real change in tone from the Federal Reserve. And in fact, they cut rates at the end of July and are projected to cut rates at least by a quarter point again tomorrow when they conclude their current September meeting. And you can see that the 10-year bond yield, which is represented in the green line, actually peaked in October, well before that Fed meeting and that last increase. And we've seen those rates come down fairly dramatically, and that's, in fact, one of the key reasons why we've had a yield curve inversion this year. So much so, but by the end of August, we've seen the 10-year Treasury yield come down by 165 basis points. But now compare what's happened with the trend in that line with the blue, gray, and red lines up above, which are the best available rates as measured by bankrate.com for new auto loans as well as used auto loans. And you can see that basically auto loan rates are flat relative to the last couple of months, but continue to be higher than they were a year ago. So despite this movement down in 10-year treasuries and other kinds of bond yields, and also in other consumer loans like mortgage rates, we just haven't seen a decline in auto loan rates. And that's one of the key reasons why consumers have not been kind of eager to purchase, because actually their purchase expressed through monthly payments has certainly not been compelling for them to be able to buy. And that's what this next chart shows. This comes from our Dealer Track F&I platform data, and you can see that we've been seeing a significant increase in the monthly payment, particularly for new loan financed new vehicles, which is represented in blue. At the same time, we haven't seen quite the same inflation in the green line, which is represented used vehicle loans, and that's because the consumer is far more sensitive, far more likely to be subprime related to the used car market. And even though they are facing higher rates, just like in the new vehicle market, and facing higher prices, they're able to substitute to cheaper vehicles, but they're not able to substitute to cheaper vehicles in the new market, and it's leaving payment inflation essentially at an all-time high. It's therefore made the used car market much more attractive in comparison, especially if you are constrained in credit or are focusing on a particular payment level. It's also made leasing a far more important part of the market, especially as we've seen strong used vehicle values helping to stabilize the residuals that lead to the lease payment. But it's not just interest rates that have been causing this issue. We've been seeing a tremendous shift and a decline in affordability related to the movement in the average MSRP. You can look at this chart, which shows you the distribution of MSRP by price ranges back to 2012. And in 2012, 54% of the market was priced under $30,000. But year to date in 2019, the average sticker has has been approaching $40,000, and as a result, less than a third are priced under $30,000. And by contrast, if you look at the most expensive end of the spectrum, we've gone from $50,000 stickers representing only 6% of the new vehicles sold in the U.S. to now a full quarter of the market. And so that affordability crisis is not just being driven by the cost of financing, but it's also being driven by a more expensive vehicle. Now, we did enjoy the strongest retail SAAR of the year in the month of August, and it's important to note that one of the key reasons why that was the case is that we've seen a tremendous increase in incentives and discounting this summer, especially relative to the fairly stable performance that we've seen in new vehicle pricing and discounting and incentives over the course of the prior 12 months before this summer. Basically, OEMs backed off of an increasing level of incentives that was starting to pick up back in 2016 and into 2017. And actually, we saw declines for most of 2018 and through the beginning of this year. But that trend has started to reverse, and that's part of the reason why consumers saw a little bit less payment and price inflation in the month of August, and it made it more compelling to purchase. But nevertheless, when we look at our forecasts for the year, we continue to expect that the year will end with new vehicle sales of 16.8 million, which is basically a decline of 2% year over year. But I would focus your attention more on the retail part because that's clearly what's more important to dealers in the audience, and that's where we're seeing a more substantial decline. We're actually seeing twice the decline that we're seeing in the market overall of 2%. In the retail, we're seeing a 4% decline. And the key reason for the difference is that actually the strongest part of the new vehicle market has been fleet sales. And this is fleet sales of all varieties. We've seen growth in rental purchases as well as growth in government and commercial. And much of that has to do with the tax reform that was implemented last year. Last year, we also saw a significant increase in fleet sales, and we're really not seeing momentum slow down. And one of the things to point out is that there's an element of these fleet purchases that's actually good for dealers. I've heard some of dealers refer to it to me as fleet tailing, but that's basically when vehicles are bought by local businesses like contractors to florists to delivery companies that are using vans at the local level. Basically, a lot of those vehicles are still purchased through the dealer and even financed and serviced as well. So not all of this fleet is bad, but it's definitely the strong part of the market that otherwise is masking that consumer purchases are on the decline even more. When we drill into the make story, it's a pretty interesting mix of winners or losers. It is certainly not the case that every brand is down similarly. We actually are seeing several brands see increases in share and, in fact, selling more vehicles on a year-over-year basis. And so when you look across the brands represented in the biggest share winners on the left hand in green and the share losers in yellow on the right-hand side, there's an interesting mix of international brands on both sides of the ledger, but certainly a significant number on the left in green. And the way that I would characterize those that are enjoying growth or at least maintaining or growing their share in a declining market are those that are best positioned with vehicles, but also I would say tending to have more range in vehicles and more options, which increasingly are international brands as opposed to the domestic brands that have largely decided to move away from selling more affordable sedans. We're also seeing a regional picture evolve with very different variation across the country, most notably the retail sales, which take a few more months for us to have all the registrations to confidently put them in the place that they're registered in the country. But it's been a much more significant decline in the western half of the United States in contrast to the eastern half of the United States. Some of that has to do with, I believe, the housing market, which turned more negative and started to decline sooner in the West Coast. but it's definitely showing some trends that wouldn't necessarily result in even the same brand performance from one region to another within the country. And then if we look at the shifts that are occurring within the new vehicle from a segment perspective, as I mentioned, we have seen domestics pull away from producing and selling sedans. We've seen a multi-year decline in the share of the new vehicle market represented by all sedans together, which is labeled or represented in the gray line on the left. However, this is the year that share seems to be bottoming out. Year to date at a 30% share, potentially could get as low as around 29%, but it's definitely the case that the decline that we've been seeing is starting to reach the floor. And then likewise, where all the growth that had been occurring that was eating into the declining share of sedans has been in SUVs and most notably the growth of crossovers. But that too seems to have reached a ceiling and is no longer growing. Year to date, the decline in cars is actually coming from growth in the pickup truck segment. And that's a result of all the new models and the activity that has been focused on that highly profitable segment, which goes across both international and domestic brands. But when we compare the new vehicle market to the used vehicle market, and here I'm using the proxy of what we sell of wholesale vehicles at Manheim, we still see the car being dominant, but it's no longer 50% of the market. And so the change that has occurred in the new vehicle market, which typically takes about 3 to 4 years to really play itself out in the volumes represented in the wholesale market, it's definitely one that we're seeing fewer and fewer sedans. There's no growth there. There's actually decline in sedans. And where the growth is, it's entirely in the SUV. The used market overall has enjoyed multi-years of growth. And what I would pay more attention to rather than the market overall, which does seem to be slowing down and at worst down maybe 1% or less when we look at total used vehicle sales. What's most important to dealers is what's really happening with used retail sales. And actually on that front, we are projecting that there will be at least 1.5% growth in used retail sales or sales of used vehicles by dealers in 2019. And more importantly, the wholesale volumes and what's happening feeding used vehicle sales, as well as the strong demand that's being driven by affordability, is laying the opportunity or the foundation for used vehicle sales to continue to grow over the next several years. And it's not just we're going to be done this year. Now, the market has seen a very strong period of more than 2 years of above average used vehicle price performance. Much of that has to do with the growth that has occurred, especially with younger vehicles fueling the retail market today. It's also been related to the shift that is now being represented by more expensive, bigger vehicles, more trucks, more SUVs in the mix in sedans. But actually in August, we had the lowest year-over-year performance. It's been the first price performance that's actually been below the 30-year average in the year-over-year Manheim Index performance. And you can basically characterize that what we're seeing in prices is regressing more towards normal. Some of the comparison, though, year-over-year relates to how strong last summer was. And in fact, we're entering a period where we might actually see declines in the Manheim Index for the next couple of months before we stabilize at the end of the year. We think that used vehicle prices are actually going to end the year at roughly up 2%. But what I meant by how you look at what's trending with prices, sometimes in the Manheim Index, it's difficult to see a normal depreciation pattern. And that's where looking at a specific vehicle or at least locking down a model year really helps for you to see how prices are performing. This is a chart showing the 3-year-old MMR, the Manheim Market Report, for 3-year-old vehicles. We choose 3-year-old vehicles because they typically are 20 to 25% of the vehicles in the wholesale market, and as a result, they're the most important cohort to watch because typically as their prices go, so do the other model years. So what we see in a normal year, this is showing what prices look like starting out in the first week, indexed to that level, and then progressing through the year. So what you would see in a normal year is that prices at the end of the year are down about 10% relative to how they started the year. But it actually masks the fact that we have a spring bounce, which causes used vehicles to be stronger and actually appreciate when tax refunds are being distributed. And then once that kind of sales frenzy ends, we typically see normalized depreciation occur throughout the year. So the slope is fairly steady, at least in a typical year like represented by 2014 in the gray line. However, you'll note that we've had two very abnormal years. 2017 was kind of punctuated with hurricanes in August and September that effectively caused no price depreciation in the summer months, and that was also the year that this rise in younger retail demand really started to take off. Last year, we even had even crazier price performance driven by fears of tariffs and higher interest rates that we believe caused consumers to pull up purchase plans into the summer months and early fall rather than the end of the year. And so as a result, we actually had price appreciation and we didn't really see normalizing depreciation until we got into the last 3 months of the year. So this year, prices actually started off weak. Part of that was they were correcting from that abnormal price strength in the back end of last year. But then we had a spring bounce. It was actually a fairly strong spring bounce, similar in magnitude to last year, but just coming off of a lower base, which interestingly left prices, a bit more of a value. So in other words, they didn't really hurt the used vehicle market quite the way that we saw higher prices do last year. We've seen low to slightly below average price depreciation over the last several months. But basically, starting in August, we've started to see a more normal pattern with depreciation, and it's a clear difference relative to where we were this year. And it's why we think the Manheim Index could go negative in September and October, and then start to stabilize on a year-over-year basis. As we look to the future, part of the reason why we believe the used retail market will continue to be strong in terms of volumes and even offer growth is that while we are about at the point that off-lease maturities are peaking, and we think they'll peak this year at 4.1 million maturities feeding those off-lease volumes, we actually are no longer expecting a decline from that. We actually think this is going to plateau for at least the next year and potentially 2 more years as a result of the fact that we've been seeing lease penetration grow, which has been related to that kind of answer to the affordability challenge. And then as I step away from sales and prices and just look at what dealers are telling us, we publish a quarterly dealer sentiment index, and this is the results that we just released yesterday with through Automotive News, and it was also reported on by AIADA yesterday. What we were seeing in this is actual stability for franchises to views of an improving market, but when we look at dealers in aggregate, we're seeing that independents are becoming more negative about the market and describing it as weak. This is a diffusion index, so when we have a score of 50 or higher, it means the majority of dealers consider it strong. So the yellow and the increase means that franchises say that the market was strong in the third quarter and, in fact, directionally stronger than it was in the second quarter. But the blue in aggregate is really being pulled down by the independents in red who are describing the market as weak. And then we also ask a forward question, sort of like the Consumer Confidence Index that I was asking earlier, where we're specifically asking for opinions about the next 3 months or the next 90 days. And here we're seeing more of a common trend that in total dealers are becoming less optimistic, but the blue aggregate number remains above 50, which means the majority of dealers still think that the market will be strong in the future. However, you can see there's a real contrast between franchises who continue to be optimistic about the future, whereas independents are becoming negative. And when we drill into what's driving that, largely the independent story is because they're no longer seeing growth or expecting growth in used vehicle sales. And a lot of that has to do with their challenges with inventory. They tend to sell more value-oriented vehicles that are increasingly harder to get. And likewise, they're seeing some credit challenges with their largely subprime consumers. It's not the used vehicle market that we're seeing the franchise dealers complain about or become less positive about. In fact, it is more having to do with tariffs. So when I drill into the issues that basically are the factors that dealers report as negatives, we've seen pretty good stability this year that no single factor has been getting worse. And in fact, a couple of factors that were more of a problem last year or over the previous quarters, like interest rates and staff turnover, have been less of an issue. Clearly, for franchise dealers, the issue is concern about import tariffs. And these are the threatened tariffs that would apply to imported vehicles as well as parts. In fact, this is the one item in the survey that franchise dealers are most negative about. 59% of them essentially are saying that they believe that if tariffs are implemented, they will have a negative impact on profitability. Independents are a bit more neutral on the category, and certainly not as many of them are negative. And so when you take a step back and you consider what is that risk on the market, and clearly I expect the audience on the webinar today, it falls into the camp of actually being more concerned. I took a moment before the webinar to look at if I could filter down and separate dealers who represented foreign makes as opposed to the domestic makes. And indeed, where we're seeing the decline in optimism is principally in the franchise dealers coming from those that represent international brands. And you can see on this chart, although I'm not looking at it from a brand perspective, I'm looking at it from where is a vehicle assembled. We have some very important dependence on notably three different regions that are kind of at risk. One is Mexico and Canada, which continues to be at risk simply because the new NAFTA hasn't been ratified. But perhaps most important to the folks on the call is the risk for the vehicles that come from Japan as well as Europe. South Korea is also a significant chunk. However, that appears to be the one region of the country that doesn't have as much of a risk hanging over it. So actually, I wanted to conclude with kind of the open items that we have on tariffs. Now, the good news is we started to get early reporting yesterday that a deal has been reached with Japan, which is what we were expecting to come with the threat of the tariffs being implemented on both the European Union and Japan postponed until the middle of November. It was expected that that was done in order to have the time to negotiate a deal. And it is certainly one of the most hopeful parts of the market that we're going to take that risk off the table. But that still leaves us with several other risks. One that, as I pointed out, we still haven't seen the new NAFTA or USMCA ratified yet, and in fact, it's looking increasingly like it's going to be a political issue that the Democrats are going to require some renegotiation of the terms, which could put the overall deal in jeopardy. Even if we get a deal with Japan, we haven't resolved the issue with the European Union. And that is significant, especially for the luxury market, but also some of the other segments that I showed on the prior chart. And then, of course, we have the lingering concern with China, which isn't a source of brands in the market today, but is a source of a lot of components, mainly having to do with electronics, and now in the latest round, impacting electric vehicle batteries. And then finally, we actually have the issue of needing to have a deal with the UK if indeed kind of Brexit occurs. And just to put a little bit of kind of levity into the discussion today, I would like to quote the famous American author Katy Perry, whose current top 40 hit, Never Really Over, says, "Though it was done, but I thought it was done, but I guess it's never really over." Because I think that applies to the scenario that we have. Even though we've got good news supposedly coming on the Japan front, we really need to see those details, and we really need to see that actually agreed to and implemented before we can completely feel like that risk has gone away. So with that, I'll see if we've got any questions to answer. I don't think I've seen anything posted, but I want to give the opportunity if anybody on the call today does want to ask questions. Rachel, I'm not seeing anything. Are you seeing anything on your end?
No, I'm not. So I'll just take this time. Jonathan, thank you so much for taking your time to speak with us today. We really, really appreciate it. I don't think we've ever had a presenter quote Katy Perry, but I love it. Thank you for that deep quote. For everyone on the line, to keep our fall Auto Talk series going, join us back here on October 8th as Erin Kerrigan of Kerrigan Advisors discusses the buy-sell market for 2020. Be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org or call 1-800-GO-AIADA. Thanks for joining us, everyone, and have a great day.